I do a lot of trainings and a lot of webinars, as a lot of you know. Fun fact, raised on a cattle farm, kind of have a small farm inside my house sometimes too, because I like to foster animals with a local animal shelter here in my area. As mentioned, I want to show you guys some fun things before we dive into the down payment assistance, including our free broker marketing studio. And then we're going to touch on some of our niche products after we go through the DPA that you guys may not be aware of. If you're not yet approved with Orion, I will definitely cover how to get that done at the end of the webinar as well. A little bit about Orion. The company was literally formed around the broker experience. So everything we do is centered around that. We do quarterly broker roundtable meetings to listen to various brokers, different brokers every time about what are we doing that you like, that we don't like. And then we're constantly making changes based on that feedback. I'm lucky enough to have my own inside team with Orion. So after the call, I'll shoot you guys all of this information in the webinar, by the way. And if you want the recorded call, just shoot me an email. I'm going to keep my email address and phone number at the bottom of your screen here. So if you do want a recording of this call to share with your team or to go back through it later, just shoot me an email and let me know that. One thing I love about Orion is we do not hide people from you, including underwriters. So all of the contacts for a file are going to be listed right at the top of your loan approvals, including the senior underwriter and their email address, their direct phone line, and all of our underwriters are experienced. They've been doing this a long time, which is awesome. We also have employees in every time zone. So I myself have brokers from Hawaii all the way to the East Coast, and we try to make sure that you guys are supported no matter what time zone that you're in. So these are contacts that I'm going to send you after the call. My favorite contact on this list is our scenarios desk. That's scenarios@orionlending.com. You guys are more than welcome to reach out to me or to our scenarios desk with any guideline questions. If you're having trouble calculating self-employment income, you can even send them the income docs and ask them to check it for you, which is awesome. Just beware, they do ticket and keep track of who we're spending 3 hours calculating income from. And you want to make sure you're sending those loans to Orion, of course, since we're putting the time in to help. One of the awesome things that all of our brokers love about Orion is, of course, our technology. Rumor has it our company spent about $6 million on our technology. You can definitely see it when if you're one of our approved brokers, it definitely shows. The system just works. If you upload something, it's there. We have some cool features like our strike price alerts. So if you're floating a loan and you want to be alerted when pricing reaches a certain rate at a certain credit, you can set that up and it'll text you or email you. We pull in title fees live. So when you're getting ready to send disclosures, if you type in the name of the title company, it pulls in all of the actual title fees live. They're not inflated. We guarantee that they're correct, and we will cure them at the on the final CD. But lots of cool features. And by the way, if you guys are interested in learning a little bit more about our portal, I'll show you how to sign up for a demo where our help desk will actually take you through a sample loan submission so that you can see the portal. One cool thing we added is you can run DU and LP in our portal side by side, compare the results and see what the difference is in if there's an appraisal waiver on one or one has lighter income docs. So that's a pretty cool feature. We also try to make appraisals easy for you. We have over 15 AMCs approved, and you do not have to sign up with them because we're wholesale. So we're signed up with them. That's all that matters. You can even set up appraisal panels with some of our AMCs. So contact me if that's something you're interested in. All of the appraisals pull back into our portal and task to the underwriter automatically. We handle revisions for you. And we even have a nifty little payment link. If you have a borrower who doesn't want to share their credit card information with you, then you can place the order, defer payment, send them a little link, and they can place the payment on their side, which is awesome. This part I love. So we have a free broker marketing studio available to our approved brokers. You're just going to click on Marketing Studio at the top right of your screen once you're logged into our portal. And we have all kinds of flyers that are already designed for you guys. So we've already done the heavy lifting for you. We've already put these together for you. They are going to be your branding, not our branding. So Orion is not going to be on the flyers. It's going to have your information. And we even have social media posts. There's all kinds of stuff. Everything's in English or Spanish. And if you don't like a flyer or a marketing material, they're easy to customize. We have over 1 million copyright-free images in the image bank in there. So you can just click on the image, swap it out. You can change the font, change the text. These are fully customizable and you can save them. You can even send them to real estate agents directly from the portal as well, which is awesome. And of course, there's tons of down payment assistance flyers and materials in here for you guys, ready to rock and roll. So definitely check that out as well. And as mentioned here, if you can scan this QR code on your screen, if you are interested in getting a demo of the rest of our website and our portal, which is awesome. This will be with our help desk. You can sign up. They do these every Tuesday and Thursday. You can pick a time and watch a demo of our system live. Also, when you're in our portal, we have a star support. So you'll just click this support chat. It will pop up a screen to open a chat. It will start as automated, but there's always an option to transfer to a live agent. One thing our brokers love knowing is we never call your clients to refi after closing. So we have a phrase, your clients are your clients for eternity. And what we're doing, we take that one step farther. We monitor your borrower's credit after the closing. And if at any time a mortgage company pulls their credit, you're going to get an email that looks like this within about 24 hours of that to let you know that, because they're probably shopping for a refi. So that gives you an opportunity to reach out to them and see if they're shopping for a refi. If you send the loan back to us, we will waive our lender fee. So that gives you about $1,000 leg up on your competition. Our lender fee is usually $9.95 for most programs. So that's awesome. And we also go through your pipeline every 6 months, your closed loans that you've closed with us, and highlight any refi opportunities. So we'll send you an Excel spreadsheet. It's going to include what we think the property value is, what we think their credit score is, and highlight what rate they closed at, and point out any refi opportunities that you may have. So we're really trying to bring value to our brokers and help you guys out. That was a suggestion that we got at one of our broker roundtable meetings that we put into place. Also, we have fast turn times. When you're in our portal, if you click on current turn times, it will pop up what the current turn times are. Right now, we're about 1 day for everything. We've been there, months and months. We've kept our current turn times very consistent. So about 1 day setup, 1 day underwrite, 1 day closings, and that's even for down payment assistance loans. We're at 1 day turn times as well. So to get to the meat of the webinar here, I do want to jump into our down payment assistance. So if you're multitasking, this would be a good time to tune in, because we are going to move fast and I don't want you guys to miss anything. Also, I hold your questions if you can until the end of this down payment assistance section, because I think I'm going to cover most of your questions, and anything I don't cover, we'll take questions at the end that you can type into the chat. The down payment assistance programs that Orion does, this is down payment assistance in the form of a soft second mortgage. And what that means, if you're doing a 96.5% FHA purchase, the 3.5% down payment assistance is going to be held as a second mortgage, so that, for example, the CLTV would be 100% if you're doing an FHA loan, or even higher, and I'll show you those options. But a good rule of thumb is that the down payment assistance is going to cover the down payment on the transaction. The broker compensation, and by the way, these are all borrower paid comp, that's the DPA rule. No lender paid comp on these. And a good rule of thumb, the borrower paid comp can usually be covered by the lender credit on the rate if you choose a high enough rate. What's not going to be covered are most of the other closing costs and prepaids. So a good rule of thumb, the borrower is going to need to have enough to cover their closing costs and prepaids, unless you have seller contributions or a gift or a combination of the three. So just keep in mind, if you have a borrower that comes to you and they're like, I have a contract, I have $500 in the bank, I have no seller contributions on the contract, that is not going to work, because either the borrower has to cover the closing costs and prepaids, or the seller or a gift. So the down payment's going to be covered. In most cases, you can have your compensation covered by the lender credit on the rate, but somebody's going to have to pay the closing costs. So I like to make sure that's clear. Why do DPA loans? So obviously this helps borrowers. There's tons of borrowers out there who may have $7,000 saved up, but not $27,000. So there's tons of borrowers that you can help out there. Also, real estate agents, as you guys are well aware of, they are looking for this product. And this is a great opportunity for you to impress some real estate agents. Also, why is it good for loan officers? Well, one thing that a lot of LOs don't realize is there is a lot of money to be made in down payment assistance. And why is that? So yes, you're taking a lower comp on the original DPA closing because Chenoa, and we'll look at this in detail, Chenoa caps you at 1.5 borrower paid comp. Our National Home Buyer Fund allows you to go up to 2, but these are closed at higher rates because DPA rates are higher. So this is a slam dunk opportunity for you guys to reach back out to them 12 months down the road and refi them into a lower rate with traditional financing and get your full comp or get paid on the loan again at that point. If you're just closing a regular borrower without DPA, let's say you're closing that, you're getting paid your normal 2.5% lender paid comp, you're done. If you do a DPA loan, and let's say you get paid 2 points on this closing, and then your normal 2.5, 12 months down the road, when you refi them, you've made 4.5 points on a borrower in 1 year. So there's a lot of money for LOs out there for DPA. And we're going to take a deep dive into it so you guys really understand how these work. You're not required to refi them, but what a lot of my brokers are doing that are setting, that are specializing in DPA is they're just setting it up that way from the start. They're telling their borrowers, hey, I'm going to close you at this 4.75 rate, make your payments, keep your credit good, and in 12 months, I'm going to call you and refi you and we'll lower your rate. The reason I'm saying 12 months is because FHA or HUD has a rule that if there's a junior lien on the mortgage and DPA is a junior lien, then you have to wait, you have to have 12 months seasoning before you can refi them. So that's the reason I'm saying 12 months. If for some reason you're going to refi them into a conventional loan when you call them and do the refi, then you only have to wait 6 months. And you do want to wait 6 months because, as you guys know, the broker recapture, the comp recapture period is 6 months. So with any lender, you really don't want to pay off a loan or refi a loan within 6 months of the initial closing. But if you're going conventional on the refi down the road, you could potentially wait 6 months if there's enough equity in the property at that time to pay off the first and the second and fit within the LTV caps. And I see a question in the chat. We don't do down payment assistance on refi. So down payment assistance is for purchases only. But what I was saying is this does give you guys an opportunity to close them on the down payment assistance purchase and get paid on that one now, and then call them and refi later to lower the rate and get paid again, which is awesome. It's one of the beauties of down payment assistance. What's awesome about doing DPA with Orion is that we're fully delegated with full underwriting authority, so we can close these quickly. We don't have to send these off for underwriting approval prior to close like a lot of other DPA lenders do. If you've heard nightmare stories of DPA taking 3 and 4 months, that could be with a lender that has to send these off prior to close. We don't have to do that, so we can close these just as quick as any other traditional financing. We have programs for FHA, USDA, and conventional. As mentioned, our portal is insanely intuitive. It's going to structure the DPA for you. So even if you have your 3.4 file set up as just a traditional FHA purchase, that's fine. When you pull it into our portal and select the DPA program as the loan product, it's going to override that and set up that second mortgage for you. Put the CLTV correctly for you. We do all of the disclosures for you on the first and the second. Remember, you're going to have 2 sets of disclosures every time. So 2 1003s, 2 LEs, 2 CDs, to closing packages because you do indeed have a second mortgage, but we do all of that for you. We actually don't let you guys disclose on down payment assistance. So we're going to do it for you. And you're also only going to have one loan number in our portal. So you're just going to have the loan number on the main first mortgage. You're not going to have a loan number in our portal on the second because we handle all that for you behind the scenes. And our DPA programs do not require that they be a first-time home buyer. There is one situation where they would have to be where it's a Fannie guide, and we'll go over that. But the DPA programs themselves do not require first-time home buyer, which is awesome. So let's look at FHA a little closer. So we have two down payment assistance programs for FHA. One is our National Home Buyer Fund, and one is our Chenoa Fund. I like to think of the Chenoa goes down to a 600 score. The National Homebuyer goes down to a 620. And just based on the pricing structure and the lender credit with the pricing, usually Chenoa is the best fit if your borrower is between a 600 and 659, whereas National Homebuyer Fund usually prices out with more lender credit at 660 and up. So just a rule of thumb, if you're trying to decide which way to take them, that's a pretty accurate rule of thumb. National Homebuyer Fund allows up to 3.5% on the down payment, which obviously for FHA is the amount of the down payment. It will all be covered. Chenoa will also do a 5% option, which would be 3.5 towards the down payment plus 1.5 towards closing costs. And we'll look at an example. But basically, as you can imagine, that additional 1.5 towards closing would cover your compensation, which is pretty cool. National Homebuyer Fund allows up to 2 points in comp. Again, all borrower paid comp, and Chenoa it caps you at 1.5. The similarities between the two, both of them have a 0% interest on the second mortgage. So obviously they're going to have an interest rate on the first mortgage. We'll look at pricing examples, but with both products, the interest rate on the second mortgage is 0, and there's no monthly payments on that second mortgage. The main difference between the two products, Chenoa is actually forgivable after a certain amount of time. So if they do the 3.5% DPA, they have no 30-day lates for a 36-month period. That second lien would then be forgiven and drop off. If they do the 5% DPA, which includes 1.5 towards closing costs, that one has a much longer forgiveness period of 10 years of no 60-day lates. I will tell you this, even though my brokers, even if they're closing them with Chenoa that is forgivable, a lot of those are refining into a lower rate before the forgiveness term, which is fine. But if you refi the loan after 12 months, like we talked about before the 36-month forgiveness period, they would just have to pay off that second lien. There's no interest being accrued, so they're just paying back the amount of the down payment assistance. The National Homebuyer Fund is not forgivable. So whenever they go to refi or sell the property, the amount of the down payment assistance would then be due at the closing table. But again, no interest accrued. There is 0% interest. Chenoa allows a manual underwrite. National Homebuyer Fund does not. So you need an approve eligible with National Homebuyer Fund. You can, of course, run the DU in our portal. National Homebuyer Fund, the max DTI is just per the DU approval. With Chenoa, some of the lower scores do have DTI caps, but they're pretty high. So if they're under 640, you can go up to 45%, even 50% with certain comp factors that I'll email you guys after the call. If they're 660 and up, just per the DU approval, per HUD guidelines, no special parameters for Chenoa. And I saw this question in the chat, can we do DPA on a 3 to 4 unit? So not on a 3 to 4 unit, but Chenoa allows you to do down payment assistance with a 2 unit, which is awesome because they can buy a property with down payment assistance, live in one side, rent out the other side for some rental income. National Homebuyer Fund does not allow a 2 unit, but Chenoa does. That was a great question. Both of these allow non-occupying co-borrowers as well. And at least one of the borrower must complete an education course. Very simple. I can send you guys the link, but just they can take an online course in 1 hour. They have about 8 different time slots during the day. Any HUD approved counseling will work with National Home Buyer Fund, but I do have one that I can send you guys that's about $30 for National Home Buyer Fund that they can knock out quickly. For Chenoa, it's only required if the borrower is under a 640, and that we do have one that a education course that's free for Chenoa. So I'll send that I'll send that to you guys as well. And then I got a question on the 2 units. So Chenoa allows, it can be a single family residence or manufactured home or a 2 unit. So just keep in mind, these all need to be owner occupied, which means if they are doing a 2 unit, that they need to live in one side. And then of course they're able to rent out the other side of the 2 unit. And then income limits. It's a common misconception that DPA is only for low income borrowers. That's not the case with our DPA programs. And I'll show you a little bit more about this. We'll look at an example, but National Home Buyer Fund allows our borrower to go up to 160% of the area median income for families in that area. And Chenoa allows up to 115 with the soft second, and even has no income caps on another option that I'll show you. So here's what you'll do. I'll send you guys this link, but you're just going to look up the county limits. So you'll type in or select the state, select the county. I'm just going to use the Atlanta area as an example. And the median family income for the Atlanta area is $86,200. So remember, National Home Buyer Fund will allow our borrower to go up to 160% of the area median income for families in that county. So what you would do to calculate the max you would take this median family income, multiply it by 160%. In this example, that's 137,600. Most borrowers seeking down payment assistance will be within these caps. Chenoa caps you a little lower. So you would take the family median income and multiply by 115%. And in this example, it would be 99,000. Again, this is going to vary by county. So some counties will be lower. A lot of counties, it will be higher. You'll just have to look up and see what the median family income is for your area that you're looking for. And again, this applies to only the qualifying income and just the borrowers on our loan. We're not asking you about income for everybody in the household like a USDA loan would. We're applying this to only the borrowers on our loan and only the income that they're using to qualify. So for example, if they have alimony or they get bonus income, but you're not using that to qualify for our loan, it does not go into the caps. And let's see. Yes, and I see the question. Can we go back to the chart? Absolutely. I will go back to the chart for you guys before we go into the pricing. Let's go backwards. So this is I think you guys probably wanted to look at this last part of the chart again. So let's say you're doing a Chenoa loan and they're over those 115 caps. Let's say they make $500,000 a year and they want down payment assistance. That can actually be done through Chenoa. So Chenoa, the options that I'm showing you today are 2 of our most popular options for down payment assistance with FHA. Chenoa actually also has a repayable down payment assistance, which is the one that you would use if they are over the income cap. So let's say your borrower makes $500,000 a year. They're over the income caps. Can they get DPA through Chenoa? Yes, they can. So instead of it being a soft second with a 0% interest rate that's forgivable, it would instead be repayable, where they're basically borrowing the down payment and paying it back. And they would have a choice of a 30-year term on that second mortgage with a 5% rate, or a 10-year term on that second mortgage with a 0% interest rate. And again, that is only if they are over the income caps for Chenoa. Yes, and I see the question in the chat, can the co-borrower be somebody that doesn't live in the home? And yes, so both of these FHA programs allow a non-occupying co-borrower per HUD guidelines. That's a great question. So what does the pricing look like? So the pricing that I'm showing you today is pricing from about a week ago. And the reason I'm doing that is because pricing is really wonky today. And I spoke to our upper management and they said they're either going to add a higher rate to the rate sheet with more credit or otherwise adjust it back to how it normally looks. So this is not today's pricing that you're seeing on your screen. However, it is normal pricing that most of the time it's going to look similar to this. So when you're pricing these loans in our system, make sure you choose the 3.5% Chenoa Fund DPA soft second if you're pricing a Chenoa loan and not just a regular purchase. Don't go in there and just price a regular FHA purchase because that will not be DPA pricing. Down payment assistance rates are higher than normal rates. Again, this gives you a great opportunity to call them and refi down the road. So what most of these loans are doing is they're coming in at the highest rate on the rate sheet. For example, in the pricing we're looking at here, the highest rate on the rate sheet is 4.75. By the way, right now for Chenoa, you're always going to see 3 rates. So you're not going to see a full rate spread that you may for other loan types. You're going to see just 3 rate choices. Most people choose the highest rate. These are all borrower paid comp. So if you choose 4.75 in this example, it has a lender credit of 1.75. That will cover your 1.5% borrower paid comp with a quarter left over to go towards the rest of the closing costs. And as I mentioned, so the DPA, the down payment assistance, Chenoa is going to pay the down payment. Your in this example, your comp could be covered by the lender credit. What is not covered is closing costs and prepaid. So again, you're either going to need a borrower with some funds that they can contribute towards the closing costs and prepaids, or you're going to need ample seller contributions or a combination of both. And I see a question in the chat, can they refi sooner than 12 months? You're never going to want to pay somebody off within 6 months of closing because that's your broker comp recapture period, usually with pretty much any lender. So you at least have to wait 6 months. If you're refining them into a conventional loan and there's enough equity that is built up to pay off the first and the second and still be within the conventional LTV caps, then yes, you can do a conventional refi after 6 months. If you're doing an FHA refi, HUD says you have to wait 12 months. And that's a HUD guideline when there's a junior lien on the mortgage on title like a DPA. So if you're refining into an FHA mortgage, then it would be a 12-month wait. Okay, and I see a question. Can you explain how the borrower paid comp works again? So with borrower paid comp, it is not included in the pricing. So borrower paid comp is going to be a fee charged to the borrower on the CD. That is different from lender paid comp. Lender paid comp is not charged to the borrower on the CD. It is instead shown as a reduction to the lender credit, and the lender pays your comp at closing. So all DPA loans are borrower paid comp, meaning that in this pricing example that you see here, your comp is not included. So on Chenoa, you're capped at a 1.5% on the comp. It's borrower paid. So how you could look at this is you could look at this highest rate, which is usually what people do. You would take the 4.75 and it has a lender credit of 1.75 that's going to go towards closing costs. And that can be used to pay any closing cost, and your borrower paid comp is a closing cost. So essentially, if you want to look at this example, this 1.75 lender credit is enough to pay their 1.5 borrower paid comp with a quarter left over to go towards the other closing costs and prepaids. And I see a great question in the chat. Can you do a purchase with DPA with a 21-day closing? We're 1 day setup, 1 day underwrite, 1 day conditions, but where you want to be careful with that is the appraisal. So I always tell people, if you're trying to impress a real estate agent or if you've got a tight closing date and you need to close something in 2 weeks, it's not impossible even with down payment assistance, but the key is going to be getting your appraisal back in time. We do take transferred appraisals if you've already got an appraisal, but what you would probably want to do is bump that, if you don't have an appraisal, bump that appraisal fee way up It's for the disclosure purposes, disclose like $1,000 for an example, and then order the appraisal as a rush. And I do have some favorite AMCs that are pretty good with rushes. So definitely call me or shoot me an email if you want a suggestion. But if you're trying to close a DPA loan in 2 or 3 weeks, I would probably order the appraisal as a rush just to make sure you meet your closing date. And here's another example. So as mentioned, if they're 600 to 659, you're usually going to want to look at Chenoa for that product. That's the example we just looked at. If you're 660 and up with an approved eligible, a lot of time National Homebuyer Fund is the way to go as a rule of thumb. National Homebuyer Fund does have more rate options. Again, this is not today's pricing because today's pricing is a little weird. This is more typical to what you're usually going to see. So that's why I'm showing you this pricing example. So National Homebuyer Fund allows you to make up to 2 points in comp instead of 1.5. Again, it's borrower paid comp, so it's not included in the pricing already. So if you want to look at this higher rate, the 4.75, that has a 2.234 lender credit in this example. So that is enough to pay your 2 points in compensation and then have 0.234 left over to go towards closing costs and prepaids. And as you know, that is not enough to cover closing costs and prepaid. So same deal, even with this program, rule of thumb, your down payment is covered. You can usually pick a rate high enough to cover your borrower paid comp. What's not covered is closing costs and prepaids. Somebody has to pay those at the closing table, either the borrower, the seller, or a gift. Fun fact, National Homebuyer Fund also has USDA. And you may ask yourself, why would you need down payment assistance with USDA? It's 100%. Great question. So why you would need that with USDA is it could be used to cover the closing costs and prepaids. So if you do, if you're doing 3.5% assistance from National Homebuyer Fund on a USDA loan, you could do 100% financing, no down payment required, and use that 3.5% assistance to cover your closing costs and prepaids, and maybe not need seller contributions or not very much in borrower funds on a USDA loan. I want to take a minute to show you the conventional option that we have. So if you're doing conventional DPA, then that would be done through Chenoa. You can do a home ready on the first mortgage, or you can do a regular conventional loan for the first mortgage. The big difference in the conventional option that Chenoa has is that the down payment assistance is repayable. So it's not like FHA where it's 0% interest with no payments due. Conventional down payment assistance is a 10-year term on the second mortgage on the down payment assistance with a rate that is whatever the rate is on the first mortgage plus 2. So if your rate on the first mortgage is 4%, then the rate on the second mortgage would be 6%. And it's repayable. And you may ask, well, why would I do this and not go FHA? So if your borrower has a high score, like 700 and up, it can be, or in most cases is going to be better to do the conventional DPA, even though it's repayable. One, because the rate is lower for conventional DPA than it would be for FHA. And two, the MI is lower. And usually the rate being lower and the MI being lower is more than enough to compensate for the payment on that second mortgage. And there's usually still a benefit at the higher scores, 700, 720 and up, to go conventional DPA. The great part about conventional DPA is it is just per Fannie guidelines. There's no real overlays except the 620 minimum score. The DTI is just per the DU. One thing I like to point out, and these are not DPA guidelines, but these are Fannie guidelines. If you go with Home Ready on the first mortgage, then Home Ready caps the borrower at 80% of the area median income, but Home Ready does not require that the borrower be a first-time home buyer. If you instead do regular conventional on the first mortgage for DPA, there's no income limit, obviously, but fun fact, Fannie says that if you're doing a conventional loan on the first and the LTV is over 95, then the borrower does have to be a first-time home buyer. That's not a Chenoa guideline. That's a conventional guideline. So I like to point that out. And I see a question, can the prepaids and closing costs be a gift? Yes, it can. So normal gift guidelines apply to both conventional and FHA. So if they don't have their own funds and they don't have seller contributions, absolutely that you can use a gift. It can be a gift, seller contributions, or borrower funds, or a combination of any of those three for the closing costs and prepaids. And that's a great question. We don't do any commercial loans. These are all residential loans only. And then I see the question, if you have a borrower with a 740 score, can he do conventional Chenoa, but is there a chance of extra credit towards closing? So that leads me to the next slide. So again, these are not today's rates because today's rates are wonky, but what you see on your screen is going to be more typical with what the rates and pricing would look like most of the time. So what I priced out here, and there's tons of options, but what I priced out in this example was a conventional with a home ready first with 5% in down payment assistance, but with a 97% loan. So I'll let that sink in for a second. So just as you can structure these a million different ways, but in this particular structure, I really like, it really works well. So this is a 97% home ready loan with 5% in assistance. So what that 5% in assistance from Chenoa would cover would be your 3% down payment plus 2 left over to go towards closing costs. And as you can see, there's not a credit because we would need a negative sign on this pricing for that to be a lender credit. So 4 points in this example is actually at an 8th discount. It doesn't have a credit, but that's okay because we have 2 points left over from Chenoa to go towards closing costs. Your comp on Chenoa loans is 1.5. So that 2 points left over that Chenoa would give towards the closing cost is enough to cover your 1.5 comp, the 8th in discount, and have 3/8 left over to go towards closing cost. Just remember that that's 3/8 left over towards closing costs is not enough to cover the closing costs and prepaids. So once again, in this scenario, and this will be typical for most down payment assistance scenarios, your down payment is covered, your comp in this situation is covered, but what's not covered is the closing costs and prepaids. And I see a question, can you repeat why Chenoa would work with USDA loan? And what about VA? So right now we don't have any programs for VA down payment assistance, but we do have USDA assistance through National Homebuyer Fund. And how that works is National Homebuyer Fund will give up to 3.5% assistance on a USDA loan. What you would want to do is keep it 100% financing like you would do on any other USDA loan. And then you could use the 3.5 assistance instead of going towards the down payment. You could use that towards closing costs and prepaids on a USDA loan. And that may be close to enough to covering your closing costs and prepaids. And you may not need much from the borrower or along the lines of seller contributions. So those work really well. And if you guys have any specific scenarios that you want to run by me, we can absolutely do that after the call. I like to mention that Orion does full underwrites prior to contract. And we also do these on down payment assistance. So if you have a borrower that's out there shopping, you think they're going to need DPA, go ahead and submit the file to us. We would need the credit and DU, which you can run the DU in our portal if you'd like. You can associate your existing credit with that. And then what we would need is income and assets per the DU. But we're going to do a full underwrite on that. And you're going to keep that same loan number all the way through closing. No disclosures would go out until after contract. So once you have a contract, you would upload that into our portal. We would then issue the disclosures for you. These work beautifully. I think it's a great way to kind of get your feet wet and get comfortable with down payment assistance before anybody goes under contract. It's also a way to help you close these loans quicker. So if you go ahead and get your borrower approved prior to contract, they can go ahead and clear their income or asset or their conditions while they're shopping for a property, then once they go under contract, you can order the appraisal. Obviously, like we talked about, you can order your appraisal as a rush if you'd like, and we can close that loan very, very quickly. And there will be a lot of people on that transaction very impressed if you do it that way. And I see a question, can we do an 80% or 85% first with the remainder on the second? The maximum amount of down payment assistance from these DPA programs that we're doing is 5%. So you can either do, the choices are 3 or 5 with conventional, and with FHA, the choices are 3.5% or 5%. And with USDA, it's 3.5%. So we don't have any options to go any higher than that on the amount of down payment assistance coming from the borrower. But if they want to fill in the gap with their own funds, I guess that there's nothing preventing that if they want to do it that way. That's a great question. And I want to pause and see if you guys have any questions that you can think of. If you have a specific borrower that you're looking for a question on, please hold that question till after the call, and you can email our awesome scenarios desk and even attach any docs that you want to reference, or you can call me or email me with your scenario. But if you have any general questions on down payment assistance, please let me know. And great question, what is the loan limit for DPA? So our loan limits follow traditional loan limit caps on the down payment assistance. We do have one down payment assistance option with Chenoa, and that is our rate advantage program that will allow high balance loan amounts, but the rest of our DPA programs are limited to the normal county limits. And I didn't go, we have a lot of different DPA options, and the one I covered in the call today are our most popular ones, but there are other options. So if you have a scenario like this, for example, where you need a high balance loan amount, reach out to me, because we may have a DPA program that would fit into that we didn't discuss on the call today. So that was a great question. Another question, so if you refi an FHA 3.5% Chenoa less than 3 years, that second lien must be paid off and cannot be subordinated. The general answer to that is yes, that it would need to be paid off. I know on Chenoa's website, they do say that they will consider subordinating in rare circumstances, but we would not be authorized to make that decision for them. The borrower would have to reach out to Chenoa and see if they would entertain allowing it to be subordinated. It would not be our choice, but as a general rule of thumb, yes, if they're doing the Chenoa soft second, the 3.5% option is forgivable after 36 months of no 30-day lates. If they refi before that, which a lot of these borrowers do, because think about it, you're closing them at 4.75 or higher in some cases. So there can be a benefit to the borrower to go ahead and refi after 12 months and pay off the first and the second and get them in a lower rate. And we are seeing that happen a lot with Chenoa, but if they do that, then they would need to pay off the second mortgage at closing. And that's a great question. And I see a question, is there a DPA for Daca borrowers? So we're following HUD guidelines on FHA DPA. So what FHA requires is a valid employment authorization card. So we would need a copy of that. And if you have any very specific visa types that you're looking at, always feel free to send those to me or the scenarios desk, and we can let you know if it would be eligible per HUD guidelines. But HUD does allow Daca if they have a valid EAD card. That's a great question. Any other questions on DPA? And while by the way, that is the end of the training for down payment assistance. But if you want to stay on, I'm going to take 10 minutes and go through our DSCR product, which is another really hot product that we're doing right now. It's a no income doc investor loan, which you guys have probably heard about. So I will go through that very quickly if any of you want to stay on the call. Let me see what other questions we have. On a refi paying off, would be considered a cash out. So if they're paying off purchase money, which DPA is purchase money second, then it's a rate and term refi. They cannot do it as a streamline if they're paying off a DPA loan, but they could do it as a rate and term as long as all we're paying off is the first and the second. And that's a great question. And a question, can we do DPA on jumbo? No, we don't have any DPA programs on jumbo. We have FHA, conventional, and USDA. And we do, and we'll go into the DSCR product next. I see some questions coming in on the DSCR. If there's no other questions on the DPA, I'll go ahead and jump into the DSCR because we do have some interest-only options to answer that question in the chat. And I'll only take about 10 more minutes to run through this with you guys. This is actually, let me get this last question. Should financing on a purchase contract be stated as 100%, or can you write as 95% contract? So the contract can be just however you would structure it normally for any other FHA or conventional loan. Nothing special has to be written into the contract for down payment assistance. That's a great question. So nothing special on the contract. So Titan DSCR, that is the name right now of our debt service coverage ratio. And keep in mind, these are investor occupancies only. So you cannot do DSCR on on primary or second home. These are investor occupancies only. And the beauty of this product is there's no personal income docs. So no W-2s, no pay stubs, no tax returns, no income docs. We're not calculating DTI, no employment on the 1003 either, no DU. The beauty of this product is it's very minimal documentation. These are very easy to get done. Really, the big part of these is the appraisal, and I'll show you what we need from the appraisal. Basically, what we're doing on a DSCR loan is we're taking the rental income on the appraisal on the rent comp schedule and comparing it to our PITI on our subject property. We do these for purchase, rate and term, and cash out. But let's do an example. So let's say that your appraisal comes back with a rent comp schedule at $2,000. Our PITI is $1,600. To get the DSCR ratio, which is what lenders are using to qualify them, you would take the rent comp schedule, which is $2,000, divided by our payment, which is $1,600, and that gives you the DSCR ratio. If your ratio is over 1.0 and higher, that means obviously that your the rental potential on the property is at least covering your PITI. If you were to get a, and we'll actually look at an example like this, if the DSCR ratio is under 1, that means your rental income on the property is not quite covering the PITI. You won't see that a lot because usually the whole point of having an investment property is to make money, but it does happen, and we'll show you how to handle those as well. So let's say on a refi, we do cash out or rate and term. The difference in how we calculate this on our refi is we also need to look at the lease, not just the rent comp schedule and the appraisal, but if it's a refi, we want to see the lease in most cases. So we would take the lower of the rent on the rent comp schedule or the current lease agreement, whichever is lower, and divide that by our PITI, and that would give you the DSCR ratio. And in this example, the lease agreement is $1,400. The payment on the property is $1,600. So now we have a ratio of under 1. And we actually do those. We have some really cool changes that we just rolled out this week. We're going all the way down to a 620 on our DSCR. Not a lot of lenders are doing that. And all the way up to a $2.5 million loan amount as well. The minimum loan amount on these is $100,000. And I see a question, do you have to be over 1? Not on our DSCR. So the ratio does not have to be over 1 on our DSCR. What you're seeing on your screen here is our matrix and guidelines if you are 1% or higher. But great question. And I'll show you what the parameters would be if you're under 1. While we're on this screen, I just want to point out that we can go all the way up to 85% on a purchase on DSCR. Not a lot of lenders are doing that. we really have a great DSCR product. So to answer the question in the chat, if you're under one, and if you're under one on the ratio, remember this means that your rent on the rent comp schedule or the lease is not quite covering the payments. You won't see this a lot, but if you do, we do these, it's just going to have a lower income cap, and we're not going to go down to 620 in this scenario. Our minimum would be 660 if that's the case. We even have a no ratio, and you may ask yourself, why would you need a no ratio? So where I usually see no ratio needed is, remember, if you're doing a refi, then we would need to take the lower of the lease or the rent amount on the rent comp schedule. And let's say that you're doing a cash out refi and they don't have a lease agreement. So if that's the case, then you could do our no ratio product where we would not need a lease agreement from you. It just has a higher credit score requirement, and the max would be 70%. And I see a question in the chat about the interest rate. I actually priced these out before our call. So we will look at a pricing example based on today's pricing. But just a couple of fun facts about our DSCR. They can do fixed or interest only. We have a 30 and 40-year interest only. We have loan amounts down to 100,000. And this actually recently changed. We're going up to 2.5 million now on our DSCR, all the way down to a 620. We do allow first-time investors on our DSCR. Important distinction, we do not allow first-time home buyers. So this cannot be their first mortgage ever in their life, but it can be their first investment property. So that's pretty awesome. We also allow them to close in an LLC. At least one borrower on the loan has to have 2 trade lines. And we are going to look at the mortgage on credit and make sure that they have no more than 1 30-day late on all mortgages on the credit report. They can own up to 15 properties. We only need reserves on our subject property though. So whatever our reserve requirements are, we only need those on the subject property. We're not asking you for reserves on other properties. Let's see, what types of properties? That's a great question, and that's actually on this screen. So first, I want to tell you what's cool about funds. So we allow gift funds for down payment and reserves. And yes, you heard that right. These are investor occupancy loans, and we allow gift funds. So that is pretty cool. Business funds can be used for both the reserves and the down payment, and cash out. If you're doing cash out, the cash out proceeds at closing can be used to meet the reserve requirement. And this question was from the chat, what kind of properties? So we'll do single family, 2 to 4 unit, warrantable and non-warrantable condos. If you get a non-warrantable condo, send me the condo questionnaire or what your concern is on it. I'll run it by our condo desk before you submit it, and we'll make sure that it works. We're allowing short-term rentals on these like Airbnb, VRBO, and we allow transferred appraisals as well. And great question. What if the primary is in forbearance? They would have to take for our DSCR product, they would have to take it out of forbearance for the DSCR programs. And again, no more than 1 30-day late on all of their mortgages. Let's see, I want to make sure I answered all the questions. Do the borrowers have to have any rental experience? So this cannot be their first investment property. It can be their first, this cannot be their first mortgage. It can be their first investment mortgage though. So we're okay with first-time investors. It just cannot be a first-time home buyer ever. It can't be their first mortgage ever. It can be their first investment occupancy though. Can they do it right out of forbearance, or do they have to make 3 payments? So I'm going to use that as a takeaway and I want to make sure I get you that's a great question. And I will find out for us the details on that and email it to you guys after the call. And I want to take a minute to go through how prepayment penalties work on DSCR, because that's a common question that we get. So they're going to have a choice. When you register the loan, you're going to register it with either a 1, 2, or 3-year prepayment penalty, meaning if they pay off the loan, refi it, or sell it within that time period, then they would owe a prepayment penalty in that case. As far as the pricing, our 3-year prepayment penalty has no pricing hit. The 2-year has a 0.5 point hit. 1 year has a 1 point hit. That is, of course, is subject to change, but that's our pricing right now. There are certain states that are on your screens that do not allow a prepayment penalty. If the state doesn't allow a prepayment penalty, you're going to price it as a 1-year prepayment penalty, but obviously there will be no prepayment penalty in those states. How you calculate the amount of the prepayment penalty is you're going to take the loan amount times 80% times the rate on the mortgage divided by 2. If you don't want to remember that or can't remember it, email me and ask me for our Excel spreadsheet that calculates it for you, and I will email it over to you. But basically, let's do an example. So you have a $300,000 loan amount, 4.5% rate. How you would calculate the prepayment penalty is you would take the loan amount times 80% times our rate, in this example 4.5, and divide by that by 2. And in this example, the prepayment penalty would be $5,400. And I saw a question in the chat, what's the pricing look like? I screenshot this right before our call. So this is live pricing. This is our Titan DSCR, of course, subject to change at any time. I just priced a 75% as an example. That's a common LTV that we see, but we do go all the way up to 85% on purchases. I priced this borrower paid. You can go lender paid, but because everybody's got various lender paid comp plans, I just priced it as borrower paid for an example. And you can see that par with us is about 4.25, but we have rates that do go up higher. If the borrower's a car, let's see, what can they live? So this is a great question. Can they live in one, if they're doing a 2 to 4 units, can they live in one side? And the answer to that is no. And I actually got that question recently, but this is for investor occupancies only. So they cannot live in one of the units because that would actually be owner occupied. That's a great question though. Another question is this example for 1, 2, or 3 years. And by the way, it actually doesn't matter. So the prepayment, the penalty amount would be calculated the same way, whether it's a 1, 2, or 3 year prepayment penalty. What the difference is, how long does that prepayment penalty apply? So they can either choose that they would be hit with a prepayment penalty for 1 year, 2 years, or 3 years, in which how many years that they choose does affect the pricing, but it does not affect the amount of the penalty. And that is a great question. I also see a question, can I send you this presentation? Absolutely. Shoot me an email. I will send you the recorded call. Can we run LP in your system? Yes, you can. We don't need findings on DSCR loans though. So no DU, no LP on DSCR, but you can run those on other loan types. And we do, I'm going to send you the DSCR. We don't do DSCR for commercial. That's a great question. This is residential only, no commercial loans. And we do non-permanent resident aliens. And I'll send you guys the guidelines on that because that's a great question. Again, you can always send your scenarios to me. You can also email them to scenarios@orionlending.com. If you guys think of anything after the call, let me know. I also just priced out a couple of other programs for you guys while I was in the pricing engine. So we do jumbo all the way down to a 660, all the way up to pretty much 90% on purchase rate and term and 89.99 on cash out. This pricing is from today. I screenshot it before our call. Our jumbo rates are great. Our jumbo AUS tends to be the best at the higher price points. And then our Titan AUS tends to be better at some of the lower price points. This example, we're pricing pretty much par at 3.375 on a $1.5 million purchase, 80%. I do want to show you a couple of pricing examples for FHA, VA, and USDA. We go all the way down to 580 for FHA with no overlays. We do non-owner occupied streamlines for FHA, meaning if they purchased the home owner occupied, they later moved out, they're renting it out. You can do a streamline on that non-owner occupied. We have no max DTI as long as it's approve eligible. And we welcome HUD guideline. We welcome manual underwrites with no overlays all the way down to a 580. So you can go all the way up to 50% on the DTI, as long as we're meeting HUD guidelines. You just want to make sure they have no installment lates in the past 12 months. That's a biggie with manual underwrites. That's usually something that catches them up. So make sure you're checking that credit report. No installment or housing lates in the last 12 months. No new non-medical collections or charge-offs either. We also do condo spot approvals. Yay. So if you guys have one of those, we need the HUD 9991 form filled out by the HOA. If you don't know what that is, Google it, it'll pop up. That's the HUD form that we need on a spot approval. We send those over to HUD and we typically hear back within 3 to 4 business days right now. We also have the new FHA loan limits in our portal. It goes off the case number. So when you're submitting a loan, it'll ask you which year we're going off of, and that depends on when the case number is assigned. But here's a screenshot from an FHA purchase. I took this right before the call. We have a nice little 2.99 that we added to our rate sheet recently. I priced this borrower paid, but the only difference from borrower paid to lender paid is the exact amount of your lender paid comp plan. By the way, if you're an LO that's always been confused on the differences between borrower paid and lender paid comp, this is the QR code to my YouTube channel. I have a great 10-minute video on there that thoroughly explains with screenshots the difference between borrower paid and lender paid comp and the implications on the loan. Check it out. It'll really make it fall into place for you guys. We have a great VA program as well, all the way down to 580 with no overlays, all the way up to $2.5 million. Same thing, non-owner occupied IRRRLs. We can do them, no max DTI per DU. And we welcome VA manual underwrites with no overlays. So technically VA has no max DTI on a manual, but we have to be able to justify it with some comp factors, and anything over 41 requires 120% residual income. You also want to make sure there's no derogs, no lates in the past 12 months on a VA manual, maybe a 1 times 30 on a credit card, but definitely no installment or housing lates. One cool thing about Orion, and if you've been burned by this, you know this guideline very well, or if you were paying attention on your NMLS renewal, VA caps the unallowable fees at 1%. If you are going borrower paid comp, your compensation would be included in that 1% cap with most lenders across the country. Orion has a way to prevent that. So if you are going borrower paid comp for some reason on a VA loan, maybe that you're doing a streamline and you want to take a little bit less comp and get them a lower rate, as long as the final lender credit on the lock covers every penny of your borrower paid comp, we will not include your borrower paid comp in that 1% unallowable fee cap. I don't know of another lender that allows this. So this is a major plus. So for example, let's say you just wanted to make 1.5 and 2.625 had a credit of 1.527. You're going borrower paid comp at 1.5. You can do that because the credit is covering all of your comp. So we would not include your comp in that 1% unallowable fee cap. If you have questions on that, contact me after the call. I'll be happy to explain it. This is a screenshot from right before our call on our pricing, 100% VA. I priced it borrower paid comp. So the difference would be just back out your lender paid comp from the credit shown, and that would give you the difference. So strong VA rates. USDA, we go down to 620, no max DTI per the GUS, and we do high balance, manufactured homes, manual underwrites. Make sure if you're doing a GUS refer that you have clean credit for at least 12 months. And we can sponsor you. If you want to run the GUS before you ever submit the loan, reach out to me. I'll send you what we need. We'll sponsor you in GUS. You can run the GUS before you ever submit instead of waiting on the lender to run it. So that's an awesome feature. This is a USDA screenshot from right before our call. So USDA rates are pretty strong. And conventional, so no overlays on conventional, really and truly. So appraisal waivers, 1-year tax returns, if that's what your DU or LP asks for, no max DTI per DU approval. We even do no score if you have one borrower on the loan that has a score, the other has no score, run it. If you get an approval eligible, we'll do it. We do, of course, the in-house down payment assistance. We do the new Fannie Refi now. So what that is that is a conventional rate and term up to 97%. It has to be a Fannie Mae on mortgage for at least 12 months. If you don't know how to look that up to see if they're in a Fannie Mae own mortgage, email me. I'll send you the link. You can look it up. Same income caps as home ready, so up to 80% of the area median income. Most of these are getting a property inspection waiver in the DU. If it doesn't, we're doing a $500 credit back at closing to reimburse them for the appraisal expense. We even are doing conventional under 620. That is a brand new thing that Fannie rolled out. The rules of that are there have to be 2 or more borrowers on the loan. So if you have one borrower that has a 580 score, that doesn't work. What would work is if you have one borrower that has a 580 score and the other has a 780 score, that averages out to a 680. Fannie will allow that now. Orion will do that as long as you get an approved eligible. And then pricing is going to be based off the lower mid score. And you may be asking, how horrible would pricing be at a 580 score with conventional? Well, I priced that out before the call. So this is our live pricing for a 580 with conventional, and it's not as horrible as you may have thought. So it's possible, it's doable. This is what you would call, this is probably the program that you've heard of, blended Ficos. That is what this is. So real quick, I'll go through the guidelines one more time. So blended Ficos on conventional would be if you have 2 or more borrowers, it cannot be one borrower. One borrower has a score below 620. The other borrower has a score above 620. And when you average those 2 middle scores, you're at least a 620 or higher. That is what is being referred to as a blended score. You actually don't enter that blended score anywhere in the file ever, not in DU, nowhere. DU is kind of calculating that behind the scenes. The pricing is still based off of the lower mid score like you see on your screen. Okay, so what if we're over a 580? What if we're a higher score? So I priced this one out before the call. I priced this one out at a higher 760. So pretty good pricing on our conventional product. By the way, if you're not approved with us and you want a demo login to run some quick in our pricing engine, just to run some scenarios, shoot me an email. I'll send you a demo login so that you can check it out. If you have questions that I didn't cover, shoot me an email the scenarios desk. We'll get those answered. If you are not an approved broker, our broker approval process is so easy. Shoot me an email to the email on your screen. We even have an express approval option. And what that means is we don't need the full broker application from you before issuing a broker approval and logins. What we would ask you for is just an express form telling us who you are, who we're setting up logins for, and what your lender paid comp selection is going to be. No credit pull. We'll go ahead and issue logins so that you can go ahead and submit loans and lock loans. We would just, of course, need the actual broker package before your first closing with us. We even do a pricing special, by the way, for new brokers as well for the first 30 days. So I know I went over the time, and I see the chat that some of you have to jump off. Thank you so much for joining me today. If you want a recorded copy of the call, shoot me an email. I'll send you a copy of the recording. If you have questions that I did not answer on the call, please reach out to me by phone or email. I'm here to help you guys, here to support you guys, and I thank everybody for your time, and I'll let you guys get back to it. But thank you guys very much. I really do appreciate your time on the call today.